Yeah, can't
All
afford
right.
theme
Da,
song,
da, da,
Matt.
da.
Welcome, everybody, to week 11, 2025 of the Build Weekly Roundup. I'm sure you all missed us for the last few weeks, but we're all busy selling the story, selling the metal. Matt's been traveling around the world, I feel like. Same thing with Dave. So it's finally good to be back, have everybody here beyond the live stream. We've got a pretty action-packed or packed agenda for us today. So I'm just going to go ahead and kick us off. Matt, you wanted to start talking about treasury yields, so let's just go ahead and hop right into it.
Yeah, we'll start off with our core slides. Uh, what we've seen since January is basically a rally in fixed income led by U.S. Treasury interest rates. So for those of you who follow along, tune in on our weekly roundups or my appearances on other podcasts. Usually what we'll talk about to some degree would be what's happening with long-term U.S. Treasury duration. The best market signal for that, in my opinion, that's just the purest, most condensed form of duration, is this long 30-year U.S. Treasury bond that was issued at the peak of the COVID easing back in May 2020, where we issued the lowest coupon U.S. Treasury long bond that's ever been issued on record. So it carries a 1.25 coupon for 30 years. Now, those people who bought that bond, those entities, those balance sheets, they've fared extremely poorly, down 50% in nominal returns on that bond in the 5 years since that issuance. And then on top of that, you count for the inflation. You've seen probably 70 to 80% of the real purchasing power of that bond or of that financial decision lost in 5 years. So it's been an extremely poor performer from a financial asset standpoint, but it is a great signal that provides a clear view on what's happening, what the market is pricing long-term Treasury cash flows at. So
Matt,
far in 20,
what's the scale of
good.
that? What's the scale of that issuance? How big is that issuance, just overall for perspective? Do
So
you,
that issuance, I would have to check the exact size. The current 30-year bonds on the run, they're about, ballpark uh, $15 billion at the primary auction, and then they'll tap onto them like another 10 to 12 billion. So you're talking all in probably like 30 to 35 billion dollars in long-term capacity. Now, in comparison, every week we launch these, say, a shorter term T-bill, and the sizes there are much bigger
yeah.
because there's much more risk capacity on the front end because they're just less risky, less mark-to-market risk. You don't have to worry about bond price volatility the more duration you add to it. So those T-bill auctions will be 60, 70, 80 billion dollars, and they'll handle every week. These you get basically 30, 35 billion, that type of ballpark per quarter, which is also part of why this story of, hey, why with yields low, the yield curve low in the post 2008 environment, didn't we term out the debt? Well, the answer is because of the amount of deficits we're funding, that long end capacity just isn't there to finance all of your needs. So the obvious answer is like if the capacity were there, you would have done it. But the reality of the situation is there's just not enough balance sheet capacity or risk-taking capacity to take on that type of debt, and for good reason too. That balance sheet capacity would have lost 70 to 80% of its value in real purchasing power terms had we actually done what a lot of commentators were suggesting and just maxed out or dumped more issuance further out on the yield curve between 2010 to 2020 type of era. All right. So what we've seen in the year 2025, as we're closing out the first quarter, has been a rally in duration. You see that V-shaped wedge we're coming in on as we close Q2. That's really, in my opinion, kind of a sign that we're coming to a fork in the road, and price is going to decide one way or the other which direction we're going to take here on the long end of the Treasury curve. If we break higher, right, bond price goes higher and we break out of that green line. That green line is really part of a trend line that goes back all the way towards issuance. If we break out of that to the upside, we're looking at lower yields at the long end of the yield curve. Basically a bullish rally just due to more appetite for buying long-term Treasury debt. Why would that happen? Well, two things. You have to see some combination of either real growth expectations in the U.S. economy moving downward or adjusting downward, or inflation expectations continuing to adjust downward. And that's basically the story we've seen in Q1 so far this year, right? You see the Atlanta Fed survey, GDP now coming in with some really surprising trends. I think I saw it, posted as low as like negative 2.8 annualized growth, which is like, it's a very bearish reading. It'd be surprising if the U.S. economy is actually in a negative 3% type of contraction. But that's basically like part of the fundamental reason you've seen this flight to or bid put up against Treasury bonds. Now, on the other side of that, if we come out of this wedge and the price of these bonds continues down, which would basically be the continuation, is what you would call it in the technical sense, continuing that long term or that longer term. When I say longer, I'm going back 5 years. Drawdown in the price of long-term Treasury debt, or you could say equivalently on the other side of the coin, rising yields on long-term Treasury debt. But if we break below that red line, that other half of the V, that wedge we're coming into, that moment of truth, that's also in the cards too. So this is a wait and see whether there's a further rally in U.S. Treasury debt, or potentially something happens, maybe unforeseen, as the market reacts to all of these kind of plates that we have spinning in the air. Everything we're looking at with the dollar, interest rates in Europe versus the U.S., what's happening with the fiscal deficit situations for each, who's funding the military build out, all of those things considered. It's just kind of a wait and see mode, but it looks like to me this should resolve by the end of Q2 when those points come to a head. So this is, in my opinion, next to the dollar, if I had two charts to pick from, it'd be to watch the dollar and long-term duration. And if I only had one, I'd pick this one, because where the long end goes is going to be that first puzzle piece that tells you how everything breaks out, kind of in sequence over the next 2 to 3 months.
So what I'm hearing from you right now is almost in a few weeks here, we'll have a better idea on the Trump administration's kind of stance, right, on the hoping that the 10-year goes down, yields go down on that. If we see the 30-year as well, sounds like that's a good sign then for the Trump admin. Do I read that correctly?
If yields are down?
That's right. Yeah, if yields down on these longer bonds.
Yeah, that's generally the direction that the best-end Treasury would probably like to see things proceed. Yields up is not pretty for anyone. So you would, if you had to choose, you'd want to break out to the upside where yields rally. Now, what does that mean for growth and inflation, at least for the short term? That it kind of comes with its own problems, but in my opinion, those problems are much lighter in comparison to losing control of the yield curve on the long end, and which is implied by if we break down or to the downside, which would just be an order of magnitude different situation for the types of problems you would be in. So if you're the Trump administration, best end, guiding policy, the goal is to be able to term out some of that treasury borrowing from that reliance on front end bills. Lower yields across the curve would allow you to do that in this key window we're getting into over the next 3 to 4 years. We'll get into a slide later where there's open room on the debt distribution maturity schedule to make this happen. So if you're the Trump administration, you want yields down. Let's go to the next slide. Yields down is actually correlated with what are broadly considered your risk assets drawing down. So case in point here to illustrate this, I've got just two assets here on the chart. In orange is Bitcoin, which is kind of your most volatile, perceived as the highest risk, highest reward on the upside of longer duration assets. And then in the green, I've got the long-term Treasury bond futures contract. It's called the Ultra on the Chicago Board of Trade.
Love that.
Now,
Ticker.
Ticker is W, or the symbol for that futures is WN. I don't know why you got the 10-year is TY, 2-year is TU. Those are pretty easy to remember. I don't know why the 30 gets WN. I don't know. It's not a good abbreviation, but that's just what it is. But really what we've seen, so on the right-hand side, I've actually got price of the 10-year future, and instead of ascending, it's actually going from low to high on the right-hand axis. Why? To illustrate the correlation with risk assets. So price of the future on a bond will increase when yields fall, right? Price and yield are inversely correlated on a bond. So that the green line moving down is commensurate with treasury yields coming down, and vice versa. If you see that treasury or that ultra contract moving up and to the right, that's synonymous with long-term yields rising. All right. On the left-hand side, I've got Bitcoin. A lot of our listeners are of a favorable view on Bitcoin, but also because of risk asset profile, the liquidity profile, it makes a good case study for the illustration of the correlation I'm about to describe. Now, if I show this for Mag 7, it's the same trend. I just didn't want to put 3 lines on the chart to confuse everybody. But what we've seen since January of 2024 is an inverse correlation between the 30-year Treasury interest rates, kind of think of that as the level of the yield curve, and the price of risk assets, case in point here, Bitcoin. This would hold for your NASDAQ, your Qs, gold would even look similar. But basically what you've seen since January 2024 is a relationship hold where risk assets in those baskets, equities, Bitcoin, gold, etc., rally when yields on Treasury debt rise. It's counterintuitive, but that's actually the behavior we've been seeing from the market. So what that is telling me as a kind of a practitioner is illustrative of the fiscal situation, right? Yields up, you've got the debt service costs up, the interest expense up, all of that. Just makes the at 120, 130% debt to GDP situations, that actually just increases the amount of borrowing, right? The exponential increase you see in the overall Treasury debt situation, and just is kind of a positive feedback loop for money entering and like just flowing through the system. It's really reflective of an emerging market currency dynamic. Like this is what you see in like Brazil, Argentina, etc. Once you get into a situation where you've got an economy with growth, but it's lost control or losing control of the debt market, right? So yields up mean your risk assets are actually going up, should be counterintuitive. Yields down, on the other hand, is indicative of, hey, growth expectations falling, inflation expectations falling, there's a bid to safety, and then your risk assets will actually draw down with lower yields. So basically what this, is telling me is that at least since January 2024, this past 12 to 15 months in the post ETF Bitcoin environment, is that these things have coupled up, and as falling yields or as yields rally in the Treasury market, that's actually a bad sign for risk assets. So I think we can take that wherever we want to go, but it kind of jives with what we're looking for on that prior side, where we highlight it looks like we're coming to some convergence where the long end of the yield curve needs to take a fork in the road. But that's basically what's happening here when you see your drawdown in Bitcoin from 108K to 80K. It's basically responding to that same phenomenon I just described.
And this is unique to just January 2024 and onward, Matt. It hasn't. The correlation falls apart historically.
I'd have to go back and look. Like, we could zoom in and look at like periods 2018 to maybe 2020, like similar points in the cycle. It's a good point to go in and look at those to see how this behaved last cycle. But there's only been, Bitcoin has only existed for 3 to 4 credit cycles.
Yeah.
The Mag 7 trend has really, it's been building since 2013, 2014, but it was very early on. You've only got a sample size of 2, maybe 3 credit cycles to look back on, but maybe that's something we'll do in future weeks. We'll go and snapshot how, Bitcoin was a much less mature market in each of those. So that's, take a grain of salt. But we could look at NASDAQ 100 or similar. But that trend was the Mag 7 trend was still very early on, starting in 2013, 2014.
Yeah.
All of us had that perspective, working at Amazon back in 2015, 2016. Like, the market was still not ahead of that trend.
That could be an interesting episode for us to just kind of cherry pick a specific event or time period or study case and just go deep on that for an episode.
Yeah. All right. Here's a good case in point here, though. Soundbite. So for the Bitcoin longs, if you're looking for a rally out of these lows, so long as bonds are getting bid, it is going to be difficult for risk assets like Bitcoin and we're talking in a U.S. dollar denominator perspective, Bitcoin and equity markets to rally as yields come in. How those risk assets take off is actually, you're looking at a necessary condition probably of yields rising, which is a problematic case or scenario for a lot of reasons. So be careful what you wish for, I guess, would be my takeaway.
And certainly not what the Trump administration is hoping to see either.
Yeah, that's correct. It's very clear, his reluctance to tweet about the S&P 500. Obviously, there's no good news to tweet about in the last, 5 or 6 weeks. But he's fine at this point with a drawdown. He's willing to absorb it. He has the political capital. So for now, he's fine.
He's said that on multiple occasions, even contradicting Lutnick and a few other people, where Trump has said that there might be some discomfort or some disturbances, and that Cameron, I think what he said is like, well, it's still Biden's economy, for the next 12 to 18 months. So I actually think those comments from Trump came on Sunday. And I think that's partially what sparked the freak out starting on Monday, where, just anecdotally, people I talk to, they'll say things like, oh, well, we've seen from history that Trump doesn't like a bad market. And then literally he comes out on Sunday on one of the news magazine shows and says like, yeah, I'm okay with a little bit of a correction. It's like, oh, okay, wow, we're dealing with we're actually dealing with a different mindset. We'll see
Yeah.
how long it lasts. So
Yeah, there's a time to pump, and there's a time to and cheerlead, and there's a time to sit back and keep your mouth shut.
yeah,
So he's you sometimes by what he's not saying. You remember signing
yeah,
charts of the S&P 500 back in 2018. It's not going to happen at least this year, and then if it does happen in the back of the year, it won't be for good reasons. So this or reasons that are good for this administration, in my opinion. So just I guess continue to watch that with a healthy degree of caution. All right, let's talk about the corporate bond market here, because what we've seen so far this week was actually really telling on the state of monetary conditions in the as far as the U.S. dollar system. So Dave mentioned that kind of volatility we saw in equity markets starting Monday, where most people probably had their eyes on. We also had a pretty rough week in primary issuance for investment grade corporate borrowers, which is kind of where I operate pretty closely on our fixed income portfolios. So you'll see every week corporate borrowers come to market to raise dollar capital with new debt offerings. But starting Monday, we started to see, maybe there were 20 deals that the investment banks and underwriters were looking to place. You saw on Monday a lot of them stand down. I'm going to start from the right side of these tables. There's three of them on the top, the new issue metrics. This is just part of an analysis report that comes out every day on our little, you can call it like a Reddit forum for bond traders. It's on Bloomberg. But what we saw on March 10th on the far right was a rise in a metric called the new issue concession. So for perspective here, when you want to bring a new bond to market, you have to raise, let's say, $1 billion. To go get that capital to incentivize it in, you actually have to give like a little bit of a yield premium up front on that raise. So let's say you're JP Morgan and your debt is trading like same issuance, similar issuance on your curve is trading at, let's say, 4.5. Usually you'll have to pay a couple of basis points just to aggregate that $1 billion+ in capital on your bond issuance to come in and form a new fund, a new QSIP. So typically what we've seen, year to date, we started off Monday, that year to date number was 3 bips is what you gave up. And all of 2024, that number was 3.5 bips, averaged out over the whole year. On Monday, that number bumped up to over 7 bips. And that's with the books, like there was still plenty of demand to come in. These issues were over 3 times covered. What does that mean? Let's say JP Morgan was trying to issue $1 billion worth of bonds. It means they had 3 billion or more in clients who were signed up to say, "Hey, I want to buy that." Right? So I mean, your books were covered 3 times over. And then after they issue, these new issues always come in once the float starts trading on the secondary market, where you don't have to raise $1 billion. Now you're doing like the secondary market, you'll just trade maybe the 100 million or 50 million that wants to be liquid and trade hands. So you'll generally see the compression come in after the fact. But anyway, the point here is we saw a pretty healthy increase in that new issue concession Monday, and it just continued to get worse throughout the week. So on Tuesday, we saw that number hit 9.3. That's that. I'm on the middle table now. And then on Wednesday, we saw that number hit 10.1 bips. So the new borrowers were then adding 10 bips to their borrowing cost on their new debt issue. At that point, at 10 bips, you're starting to add up to a meaningful amount of cost to go in and tap the market, where now it's, all things considered, if I'm a cuspy borrower, we'll get into one of them as an example here in a second. You're only going to do this if you absolutely have to get the dollars, right? Because what the market is saying is, hey, capital suppliers are saying, hey, we're reluctant to issue new money for you. You're going to have to give us a pretty fat concession here, 10 bips, to get us to underwrite or fund your new issue. So you've seen basically a slowing down of the market. Now it was still open. It's not frozen by any means, but this was a clear slowdown. So week to date, the Bloomberg projections were to bring $45 billion in new IG corporate debt to market. So far, we placed 35. So we underfilled projections by 10 billion. And, generally these projections are actually based off of client order books or books of business, right? Wall Street knows the demand side to fund new loans. They also know the supply side of the corporate issuers who are looking to borrow, and they generally know where these things tie out. That's literally the market Wall Street is making as the middleman. So the slowing down here, the underfunding of capacity. This is going to be a very interesting point to watch come next week. The majority of these new issues will place on Monday, and they should step up Tuesday and Wednesday. But heading into a key quarter end, if these conditions and overall volatility, rates, the dollar, equities, etc., kind of continue, if these capital markets kind of start to, I'd say, freeze even more so, that will be an interesting trend to watch going forward.
So help me understand a little bit. I think I'm missing something here, right? So in the last couple slides, we saw yields kind of on that, starting to take the downward trajectory. So if I'm looking to maximize the yield I'm receiving, right, wouldn't I be more incentivized to fund these now before maybe in a couple of months, 6 months, yields are much lower in theory than these bonds that I'm actually funding are yielding less?
Are you talking from the sense of like the cap, like
in terms
the bond
of the
owners?
spread versus the treasuries? Yeah.
Yeah, you would. There's a lot of things going on here. All right, it's like how much balance sheet capacity do you have? How much capital supply do you have to allocate into the market? And then where do you assess kind of overall economic conditions?
Right.
And that'll tell you, or that will inform your allocation decisions across how you deploy your IOUs or which IOUs you're going to buy. So if you're looking at, all right,
Yeah.
I see a
This
scenario
is credit.
where-
I mean, this is not the quote risk-free United States Treasury too.
Yeah, this is credit.
Yeah,
exactly.
this is
So what
corporate.
you-
So you might have a negative opinion on corporate on these borrowers.
Yeah, exactly. So what you've seen, and we saw since January, we've seen Treasury yields come in, which is, broadly considered, this is how bond markets, credit allocators would consider like your lowest credit risk. Some would say even risk-free. Some would say. But you've seen as those rates come in, that's kind of the flight to safety, taking place as economic growth expectations and then inflation expectations come down. And then you'd say like, okay, what if I have an A-rated or double A-rated, corporate quality issuer? What happens there? Well, so far what you've seen is the corporate issues of kind of similar quality, according to the ratings agencies, A's and double A's. There's Johnson and Johnson or Microsoft or triple A's. Those spreads, their yields have actually not come in, right, alongside Treasury. So you've actually seen their bonds just hover, say it's like 4.5, as like the front end of the yield curve, the 2-year comes in, 2 to 3 years are now at 4. So you're actually starting to see now is spreads widening out. And that's kind of indicative of capital providers not wanting to lend into risk, right? So the further out you get on like your credit quality and the quality of your business, the 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 bigger concession you're going to have to give if you need to go raise capital in this environment. I think that takes us to a good next case in
I was
point
gonna say,
here.
yeah.
Stellantis, yesterday, Wednesday. Dave, Cameron, you guys know way more about cars than I've ever, like, you've forgotten more about cars than I've ever learned. So you know the company and the kind of the management quality issues they've faced.
To baseline
It's not
everyone,
well
I won't
run.
go
Yeah.
long, but Stellantis has a lot of popular brands. Their most popular brand in the U.S. is Ram pickups. So I think it's a respected brand. It's a top seller. They have they have Peugeot, they have Fiat,
Jeep
they have
too?
Jeep,
Do they have Jeep?
yeah.
Yeah.
So it's a conglomerate, right? It's one of these. It's based out of the Netherlands. It's a conglomerate of a bunch of different car brands, but Chrysler's also under their umbrella. But last year, you can go look this up, public information. They had a terrible year, 16%, 15% drop off in sales. They were killing brands left and right. They had a huge drop off in Ram pickup sales, which again, that is their number one seller in the U.S. The United States buys trucks by the hundreds of thousands, millions every year. So anyway, they're not doing well. So, Pat, back to you
No.
on that. But I think that's a macroeconomic story, right? Yes, they've
Yeah.
been mismanaged, I think, but also their top sellers, good vehicles like Ram pickups, have seen pretty big sales declines. So sorry, Matt, you can keep going.
So you're looking at, like, clearly not best of breed
Mhm.
management in the
No.
autos, despite having some well-loved brands by consumers. Not anything against the quality. Um, uh, and then on top of that, you're looking at the auto industry itself within the broader macroeconomic picture, which is facing headwinds. Let's just say that right now. It's part of, like, it's wrapped up as a key industry with import tariffs, like all the above. You're cuspy, basically. So Stellantis still carries an investment grade rating. They're triple B. They just got downgraded last week by S&P. But Wednesday they came to market and wanted to raise $2.25 billion, pieced across three different maturities. There was a 3-year piece, a 5-year borrowing piece, and a 10-year piece. And for Stellantis to come in and get that money raised, they had to give a pretty wide concession. So they paid as high as a 30 bip concession on their 3-year, and then they paid 20 bips on their 5 and 10. So all in, their spread over treasuries came in at 140 on the 3-year, 170 on the 5-year, and 215 on the 10, which, despite rates coming in, perceptibly, like bonds are rallying so far this year, your cuspier issuer, the lower credit quality you are, money is getting harder to access, which is just kind of jiving with the late innings of a cycle.
Mhm.
So that's an interesting thing to watch. We've got the last 17 days. I think how many trading days are left this quarter? There's tomorrow, Friday, and then 2 weeks, and then one on Monday. This is where things can, volatility can pick up. So this will be something that's interesting to keep your eyes on going ahead. That's kind of what we're looking at. Jives with those stories. We talk, key thing to watch is duration. Bond yields, like if we break to the upside on that chart, it's good for the Treasury. Bessent can now start issuing more, or borrowing more on the coupon issuances, longer term maturities at lower interest costs than we were getting, maybe if we had issued those last year. But for the broader economy, it spells trouble. So you've got still got some tough sledding to get through. Now, despite all of that, doesn't sound like a rosy situation. That is so much better of a perspective for the broader economy to be in that bucket than if you're in a treasury world where rates break, where yields break up, or bond prices down on the other side of that V wedge, where you start seeing, say, a world where the 30-year starts hitting 5% or breaking out further above that. That is an extremely difficult scenario because we talked about the cuspier credits having trouble in the good version of that scenario. It's just insurmountably worse when the Treasury's cost of financing is 5.5, and then you're paying 140 to 215 bips on top of that. It gets really hard as a corporation or a mortgage borrower, where your 15 or 30-year mortgage is going to be benchmarked to those like that 10-year Treasury rate. So key inflection point we're coming in on in Q2. I think everybody, probably for the good of the U.S. economy, we should probably, even though it may mean a drawdown in Bitcoin, S&P 500, etc., it's still probably the better option for the next few months.
So when we look forward, then you touched on the Treasury, maybe trying to term out some of its debt, push it out further. I'm really curious, what are some ways they might do that? So I think this next slide, Dave, if you want to touch on this,
yeah.
but
Hey,
I'm really curious how this will work.
Yeah, I'll intro this, and then Matt, I think you want to share this on your X. I don't think you did. I don't think you reposted our stream on your account there, so we might be missing some of your thousands of followers here. So, but yeah, let's talk about bit bonds here. I wasn't present. Our CEO John Ruth was present at the Bitcoin Policy Institute's Bitcoin for America summit in Washington D.C. I guess it was 2 days ago. And so there was a presentation by a gentleman named Andrew Hones. Andrew's a friend of Build. We've partnered with him. Matt's been on stage with him. He's come to some of our conferences, and always a pleasure to be around. And so just a little bit of context for what Andrew does. He runs a company called New Market Capital. Within New Market, he is running a Bitcoin-focused finance firm called Battery, and they do some pretty interesting things in, I guess, what you would call, Bitcoin-related structured credit products. So one of the things, this is not the only thing that they do, but one of the things that they are offering is mortgages, commercial. I don't think they've done residential yet, but they've done commercial mortgages where you borrow money that's secured against a building, but part of the loan is actually used to fund the purchase of Bitcoin in addition to whatever real estate you happen to be purchasing. So it's structured in a way where both borrower and lender, they have an equity stake in you basically have a lien on the building and you have a lien on the Bitcoin. But over time, as you build up, the borrower builds up equity by paying down their mortgage. They're also increasing their equity position in a chunk of that's dedicated to Bitcoin, and that's they work out all the custody and whatnot. So the idea being, if you look at historical Bitcoin price appreciation, the notion is you're getting to participate, hopefully, in a really attractive upside in two scarce assets. The one scarce asset being the land or the building that you purchase, and the other scarce asset obviously being the Bitcoin. So Andrew does a much better job of explaining it, but that's high level of what Battery does. So Andrew was on stage, and this is the slide that he presented, but he was presenting, okay, here's a potential solution for federal government funding, and that would be something he's calling bit bonds. And it's similar in structure to what I just talked about with their mortgage offerings. So his proposal was the U.S. government issues $2 trillion of a 10-year, I guess, note, and that note or bond would pay 1% interest annually, but 10% of that 2 trillion issuance or $200 billion would be used to buy Bitcoin, and ostensibly that would go into the Bitcoin Strategic Reserve or SBR, and then over the rest of it, the $1.8 trillion would be used to obviously fund government spending. So the payout, it's an interesting payout structure where you're capped as the buyer of the debt or the buyer of the bond, you'll receive basically a senior claim up to 4.5% annualized. So it's paying 1% interest, but your total return, you can get up to 4.5% annualized, contingent on 50% of Bitcoin upside, getting you to that number. If
No, you get 100 up to that point.
Sorry, yeah, 100. Sorry,
All of it
100
goes
up to
first.
that. Yeah, that's right. After that, sorry, after you hit that 4.5% annualized compounded rate in the 10 years, then it's split 50-50. So the borrower gets 50% of that Bitcoin upside, and the U.S. government gets to retain the other 50%. So it's interesting. It's definitely a bold idea that he's taken what he's doing for either commercial real estate or residential real estate borrowers, and he's trying to overlay onto the U.S. government spending and deficit conundrum. So that's the idea. I know Matt has several opinions on this, so I wanted to at least intro it and kind of take you through the mechanics. But Matt, let's start the discussion on. It's a pretty bold idea. What do you think?
Yeah. So first thought is, how do you plug in this and price it against the existing debt stack, right? Because this is a massive change to the Treasury's borrowing structure. $2 trillion is a huge placement. I'll get into that on the debt distribution chart next. But the first thing I looked at is where should this price, right? Because if you can actually perfectly replicate these cash flows on the back end with instruments that already exist. So, and these are the most liquid financial instruments that are tradable in the financial system. So start with Treasury bonds. So what you would need to replicate this is the 10-year, with, let's say, constant maturity. First perspective, that instrument you would need is the on-the-run 10-year. There was just a reopening auction yesterday. But that coupon has a 4 5/8. Now, rates have come in, so if the Treasury would have issued a new coupon bond, it would have probably priced at something like 4 1/4 coupon for just a straight unsecured bond offering. So that's part of your coupon stream opportunity cost by downshifting into this bond. And then on top of that, now your other feature is, as a bondholder, you're guaranteed principal returned at maturity. So $100 par at maturity. If you want to structure this note on the back end with the 10-year on the run to get that 1% coupon, and then also, and you only have $90 to do it, right? Because $10 went in to buy Bitcoin. What you would do for the other bit is you would need to find like the bullet payment issuance on, let's call it Feb 15th, 2035, that market date. So you can go out and buy these with what's called a Treasury coupon strip, where basically they chop up, basically for every bond, you turn each one of those coupon payments into a CUSIP unto itself. That can be market tradable with your Wall Street counterparty. These things have a CUSIP, you can own them. Kind of like it'd be a T-bill, no coupon, but much further out on maturity or higher duration. So doing that, you can actually add this thing up to get to the $100, and even still doing the sharing of the economics for the price increase in Bitcoin, even before getting the fact that you could buy the Bitcoin, chop up that interest, you could buy the Treasury, the dollar cash flows for like a net cost of like $17 below par. So I'm not sure that as structured, these would be a better deal or a preferred deal for your bondholders. On the 10 to, let's call it 14-year maturity spectrum, like basically 2035 to 2038, 39, that we'll get into, that you need to entice to buy this instead. So at current interest rates where everything lines up, it's not yet an option where you can pull them in with a carrot. What you would also have to do is incentivize the bond market participants to the idea that they're Bitcoiners, essentially. Like they want the Bitcoin collateral, they want that Bitcoin upside. And I don't mean in small size, I mean like the whole market, if this is actually going to proceed. It's a $2 trillion proposal. And if you look at the capacity here, the debt distribution schedule, 2 trillion in maturities here on the liquid, the portion of the debt that's securities, not accounting IOUs with like the Social Security Trust or similar related federal government entities. I mean, like the actual bond stack, you can't do it all in one lump sum because that 2 trillion in this year alone would be this yellow dotted column. I don't think we could place it. The balance sheet capacity doesn't exist to gobble up that credit allocation in one go. You would have to piece it up in sizes or, in small drips over a course of, let's call it 3 to 4 years. The good thing is we already have a window here on the bond maturity schedule where there is very little debt maturity scheduled for these 4 years. The reason for that, so if you think about it, your issuance 10 years out, everything that's already kind of signed up for already there would have to be from the longer dated bonds as they roll down towards maturity. And luckily, we're in this window where we just entered it, this turnover of the new year, where the old 30-year bonds maturing for the next 4 years are still pre-2008, where we had to do the first ramp up in taking on increased debt coming out of 2008. So we saw 2025, 26, 27, 28, or it's actually that would be the 30 years ago would be the late 90s. The 20-year would be those roll downs coming out of the late 2010s. But basically, we've already got this pocket where there's going to be natural demand for 10-year paper. And you can kind of plot out where it wants to be. It wants to be just naturally, the capacity should be about $500 billion for each year you could place. So if you needed $10 trillion, if you needed $2 trillion placed there, we'll be able to do that, like no questions asked. The key thing here is with these bit bonds, if you actually want to do it in $2 trillion of size, I don't think you'll get the capacity to do both, right? So either like this was the opening bid or throwing out an idea, which this is where we're at right now as, the Bitcoin adoption as collateral within credit. We're really pushing ideas first, but where the market is made, I don't think we'll be able to actually place $2 trillion there without completely changing the underlying treasury market. But then on top of that, that's essentially the entire credit market, because the 10-year treasury note is really your pricing instrument for all consumer credit, all corporate borrowing, even down to like projects, talking with family offices in Mexico City, they pencil their projects out against the 10-year rate. So this would be a huge game shift, like a tectonic shift in global bond markets. And, I have my reservations or my opinions about sovereign Bitcoin-backed debt. I don't know that it's necessary at this point, but we should approach this topic with a high degree of care and prudence, because really this would amount to like open heart surgery on this entire financial system. Yeah. Which is kind of telling to where Bitcoin is, and we're still early days, but also the Bitcoin and credit side. There is clearly an open heart surgery needed, but we need to approach this with a lot of caution, because it is systemically going to be a massive change to digest.
Is there a way to do special issue debt, smaller issuance, different time frame or different tenor, I guess would be the correct word, to experiment? Is there any appetite historically to experiment with treasury issues like this, Matt?
Okay, so when you're trying to lower your cost of borrowing, and you're running into these financial constraints as a sovereign, your first step, you can see this in like the UK, which has fallen from the global reserve currency standard with, pound sterling, with the cutoff at like World War II when that started. But over the course of the last 70, 80 years, what you've actually seen from governments like the UK to fund themselves, the first step is when you can't obtain the financing you need, assuming you're going to run deficits against, your planned budget. If you can't do it with fixed rate unsecured borrowing, your next natural step is it tends to be they call them linkers in the UK, but CPI index or inflation index debt. And when you do that, that's where you see like this quoting against real rates. You'll see on FinTwit, all of that. When you do that, you'll actually get a lower coupon cost because the sovereign is promising to tap off and grow principal with whatever, they clock consumer prices is increasing at in the overall economy. That first step is really the idea that what's really happening is your funders, or at least some portion of your capital supply, is losing faith in your sovereign's ability to manage the currency and maintain the debt's purchasing power through time. And so that first step with the CPI link is to say, well, okay, we'll take a lower nominal coupon, and that's lowering the actual interest cost. But then on the principal cost, say you're gonna have to step us up with whatever you print the CPI at. That's the first step. Now, once the investing public and capital markets lose faith in the CPI, which the government controls as a printed index, there's all types of adjustments, annually, underclocking, all of those incentives exist, right? And from a fundamental standpoint, when you're in a situation where the issuer of the liabilities, indexed to CPI, whose costs are, like Medicare, Medicaid, Social Security benefits, those are all like a lot of those are directly tied to that index. The economics incentives are for those prints to be suppressed. And that's kind of, there's a lot of discussion of this happening. Like the CPI is not actually accounting for the true rise in the cost of living. So your first step is you would increase CPI linked debt. So ours for that was tips. We started issuing tips in like the late 90s, early 2000s. Those are still a tiny portion of the overall borrowing structure. Your first step would probably be, if you had the gun to your head as a sovereign, you want to issue more tips because you do still you possess more control over the reference rate, which is the CPI that an institution in a building in Washington, D.C., like within your bureaucracy, gets to print. If it's Bitcoin indexed, you start losing control of the reference rate on your debt, and you're getting into a situation where you have much less control over the cost of your capital and your financing. So that's kind of the test route, though. You would see like, hey, we need some financing source. Let's get a pilot program. I think a good analogy for that would be tips, like where you start looking at other instruments to obtain the capital funding that you need as a sovereign. This is how things have gone typically for sovereign debt situations as a first step.
Yep.
Got it. Well, do we want to go to this next slide, or how are we feeling?
Yeah.
Yep.
Okay, so just to illustrate here for new money on the 10-year auctions, what an extra 125 billion would mean per quarter if we stretch this out, 2 trillion over 16 quarters. Just even if we were doing this for the 10-year alone, this is a massive step up in what's called new money on a bond issuance. New money is whatever's left over from what you raise after you pay off the existing debt holders. So 125 billion in new money would be a massive amount historically. Like in the powder blue, I've got tracked how much new money actually went into each quarterly bond issuance. $125 billion would be a massive step up. So however we cut it, and we're going to have to fund out there, or we'd like to fund out there, we are going to need a lot of balance sheet expansion from somewhere to get this done. So this one's up in the air. We'll see how it plays out, but just wanted everybody to come in with a full realization of how massive what we're dealing with actually would be for this idea of bit bonds that's very early in its discussion process.
Yeah.
Yeah, just seeing this chart is eye-opening for sure.
We're going to have to do it one way or the other to get the capacity there. It's like, how do you incentivize it? And it may be with the carrot, but I don't know that we can afford to give much of a carrot. It may take a stick approach, like forced capital allocations. The government with the SBR is coming to the realization, through its own process that Bitcoin is an important, if not the most important measure of capital. It knows it needs to hold what it has, if not acquire more. I don't know. It's going to be tough to design a carrot or a situation where everything gets in with the carrot. If it goes a route where they have to take the stick approach, force capital controls, et cetera, you're really lining up head to head with the core DNA of what Bitcoin is as a trend, right? It's censorship resistant, borderless, counterparty risk, like counterparty free, solves the Byzantine general's problem, inflation proof money. And so you're going up. If you try to take the stick approach, I think what you'll realize is that you're dealing with, it'll be like trying to catch a greased pig in Missouri terms, where I grew up, right? It's going to be tough to wrangle in what you're dealing with. So kind of bottom line, this is going to be a very complex situation. It'll be an exciting situation here these next 4 years, but it'll also be an extremely volatile situation as well, just for the order of magnitude of what we're already talking here with $2 trillion. We're getting into extremely impactful numbers, and what's around the corner for the U.S. Treasury, the fiscal situation, as well as Bitcoin. So time will tell, but I guess buckle up.
All right. Well, get into your
I
Dodge
think
Ram.
that's a good spot to leave it for the week.
Do your Ram pickup and buckle up, I guess. Probably on sale. Well, Matt, just to lead off, I mean, we are in the last 2 weeks of March. I think I mentioned this a few updates ago that we typically see these March and September end of quarter. These are periods of time where chaos can unfold. So I don't know if you have any parting shots on that, but it does seem like S&P is down another 140 basis points today, 139 basis points. I mean, it's just been a bad week. Gold is close to hitting 3K. It's never closed a month this high, correct? So I don't know if you
gold is usually the first to top after the climax event of the credit cycle. So if you go back and look at the charts, so the bond market, U.S. Treasury debt topped in August of 2020. I want to say gold topped June of 2020. I would double check me on that, but I think it first rallied into the 2000s, but gold was your first one done. So I think that'll be a key sign here as gold threatens this $3,000 key level,
Yeah, it was.
I'd expect, we're late innings. I see the sentiment on the Goldman Sachs marquee polls. Everybody's lining up on the bullish side. Um, this has just all the hallmarks
Yeah.
of the late innings
It was
dynamic.
August.
But
It
yeah,
was a week of August 3rd, 2020. Gold topped out around just over 2010,
so
and that was in.
so
Yeah,
gold topped that same week as Treasuries then, August 3rd.
yeah,
And then Treasuries topped out, like Treasury yields bottomed out, I want to say August 8th. Um, and then equities, Bitcoin, other risk assets, the party continues after that. But the local top in gold is something you should, if this behaves like other cycles, like this is where it takes a pause and then a broader consolidation begins as like the credit cycle bottoms and
yeah,
turns.
yeah. Bitcoin, just for the record, Bitcoin didn't start to really take off until mid-October 2020. That's when it went on a 12-month tear with a couple of tops.
Yeah. So your what's perceived as risk assets, I think that like the general framework, no cycle is identical, right? But the general framework would be after you bottom on the short-term credit cycle, you get into some sort of monetary easing, so lower rates, maybe shift out of QT into even or maybe even QE. Generally, you see the follow through on risk assets to the upside, and they'll top off later uh, in the cycle, or as the sine curve shifts over from its bottom up towards positive inflection, and then that turns over again. But yeah, what you're watching for, yeah, I think the key point, like if you have one thing to watch, it'd be duration. If you had two more choices, I'd pick the dollar and then gold to help you identify where you're on the roadmap. If you get those, if you get the duration picture right on treasury yields, that'll tell you where the dollar goes, right? Because FX markets since 2020 have been basically rewarding positive interest rates and penalizing lower interest rates. So duration is getting bid, treasuries rallying in. Dollar is kind of suffer in FX because that's what we've seen with like dollar euro or dollar JPY. So you'd watch first duration. That's your number one, in my opinion, to understanding where you are on the roadmap. Get that one right, then you can understand where the dollar's headed, and then from there maybe watch gold, watch for that topping pattern, and then that'll inform where you're at in terms of the follow through on other risk assets. It's general playbook or template you're looking for in this situation headed into Q2.
Great. All
All
right.
right. Great to
All
sign
right,
off.
everybody. Well, thanks for listening in or watching us if you're able to do that, and join us next week for another episode.